Charlie, you and I have known each other now for some time, 15, 16 years, 17 years. And I've always watched you from afar, have admired what you built. By the way, our podcast we did today, you and I did today, that like tells the origin story of Charlie, right? And the business dropped today, right? So
Oh, it
it,
did. Good.
yeah, it dropped today. So I know that my team is putting it everywhere on socials and I'm sure they've tagged you, Charlie, and if they haven't, they would certainly will tag you. But it was really cool to explore that origin story because, you know, you didn't start off lending money. You kind of fell into lending money and which is really cool. Just it's a problem that you needed to solve, and you solved it, which is what that origin story is all about. But today we want to teach people how to buy some of these assets with none of their own cash, and people don't believe that, Charlie. They're like, it's the thing that holds them back the most because they believe that they lack capital, when in reality, what they really lack is a relationship and specialized knowledge. And so with that, Charlie, let's deep dive into this and
All
I'll
right.
I'll give you the floor.
Well, thank you very much, you guys. Tell me when you guys can see this. Can you see it okay, guys? Rob?
Funding your deal with little or no personal money. Great investors, clear sky education.
Thank you, Grid.
Yep.
It's funny because Rob is absolutely right. Where there's a niche in business, you can fill it, right? So if you can fill a niche, right, you can do it. And for us on the hard money side, Rob was exactly right. We fell into it. Um, um, I was approached by a guy. See, we fixed and flipped over 500 houses and we built a pretty good capital stack. And one of my friends at the courthouse steps came up to me and he said, "Hey, Charlie, I need a loan in Fairfax. I bought a condo that's worth 350. I bought it for 225 at the Fairfax County Courthouse steps. I need a loan for $200,000." This was back in October 2013. And I said to him, I said, "Jimmy," I said, "what are you talking about?" He goes, "Yeah." He goes, "You're going to lend me money." And so I said to him, I said, "Jimmy, I don't know what you're talking about." He goes, "Yeah, you're going to be the hard money lender for this loan." I said, "Okay, that sounds good," because he knew that we had assets and we had capital that we were looking to reinvest it. And so that's how we got started into this thing called the hard money business. And I'm going to explain that to you guys in a second. So first and foremost, I want to thank Rob and Grid for allowing me to give me this platform to help you guys out. And so obviously the topic is funding your deal with little or no personal money. And so what I'm going to show you how to do is use 5 different funding sources to go ahead and fund your deals with little or no money out of your pocket. And I'm going to focus on fix and flips, buy and holds, transactional sales, and short sales. So that's going to be the basis of the presentation. Okay.
Cool. That
All
sounds
right.
great.
This is basically who I am. I don't want to really focus on who I am, just because you guys will either know me, especially at GridCon on June the 1st, we'll be there for sure. If you don't take anything out of my background, the thing I want you to take out of it is, and this is what Rob preaches all the time, it's about your legacy. I am part of a couple of charities. I give back quite a bit. I've been part of a Catholic Creating Foundations for Hope, which used to be Catholics for Housing. It's a low income uh, housing charity for lower income folks, affordable housing. I've been part of that for about 14 years, and my claim to fame on that is I helped them purchase a 60 unit distressed trailer park in Manassas. That thing has about 60 units. It gets about $900 a month, so the monthly cash flow is about $54,000. I put that affordable housing charity on the map. And also too, Clear Sky Sports Angels, which I'm gonna cover here in a little bit. It's a new charity that we launched. It's actually a foundation, and so I'm pretty proud of that. So, yeah, I got a lot of experience in real estate, but I want you to take away that when you guys get a lot of money, please give back. This is it's about our legacy, right? It's about giving back.
Charlie, I
So
love that. Can I just make a point on that? What
yeah,
I love about the charity that you set up is that it's self-perpetuating because the
yes,
asset actually like funds the charity, right? And it's like
yes,
that's what everybody on this call wants to create for themselves,
yes.
and you did it for the charity. And I imagine that you're going to do that for Sports Angels as well in some kind of capacity,
We've
right?
done it. Yeah, we've done it. And I'll explain that in a second. But here, I just want to show you this. Uh, this is one of the things we were playing with these caricatures, these AI caricatures. That's probably a much younger picture of me, even though it's not. I'm an avid scuba diver, and so I thought this was a pretty good caricature. AI, all AI did is they scanned in a picture, and I just put in a couple of interests, and out came this. And so basically, that's basically who I am. And here it is. Clear Sky Sports Angels, what it is, it's a foundation. And if you guys know Leo Pereira, his wife actually helped me out with the foundation because she's
Mm.
the one that gave me the name of the law firm in Arlington that helped me put this thing together. So what it is, it's Clear Sky Sports Angels Foundation. It is a foundation that's operating in perpetuality. And what it does is it allows disadvantaged kids to have the opportunity to play travel sports. It doesn't matter what travel sport it is. It could be lacrosse, it could be soccer, basketball, softball, swimming. I even sponsor a BMX bike club. We're going to sponsor Future Entrepreneurs of America. That's
I
something that
love
one
that.
of our friends is doing too. So this is a charity. And the way we started it is that we seeded it with about $400,000. That money is invested in a pooled mortgage fund. Shocker, it's ours. And that interest is getting about 12% return a month. That return goes directly into the operating budget to expand what's called our givability. So that foundation is in perpetuality. Anytime we get a donation, if it's over a certain amount of money, that money goes directly on top of the foundation. And it just grows and grows and grows. And so this is something that when I'm gone, this will still be there. The difference is it might not invest in a certain higher yielding bond fund. It might invest in something else. Somebody else will have to manage the money. But this is a charity that we just recently launched and it is in perpetuality. And believe it or not, this month and next month are the first months that we're going to actually start giving money out. So this is basically hot off the press. Okay, who are we? Are Clear Sky Group. We have six business lines. Number one, fix and flip houses. We've done over 500 fix and flips. That's how we built our capital stack. Number two, we have a good sized rental portfolio. Right now, it's over 50 properties on the residential side. Number three, we own commercial properties. So I'm very into the commercial property space as well. Number four, we're a hard money lender, which is what I'm going to talk about today, amongst other things. We've got about $40 million on the street. The way we're set up is we have two funds, a 506B fund and a 506C fund. We're a direct lender, DC, Maryland, Virginia, North Carolina, Louisiana, Florida. Clear Sky Holdings pretty much invests in tax lien certificates. Virginia is what's called a tax property state, so we don't do it in Virginia. We do it in DC and Maryland. The next sale in DC, I think, is the July 10th sale. We try to buy between $3 and $4 million in tax lien certificates. The booby prize is an 18% return. The good prize is if we can get quiet title to the property. So that's what Clear Sky Holdings does. And we just recently wrote a book, The Roadmap to Wealth in Real Estate Investing, and we do have a coaching and mentoring program. So basically, we have a six-line business model that we have. Roadmap to Wealth, that's basically part of our book. You guys are more welcome to get the book. Basically, it takes you with no knowledge, no education, teaches you how to find distressed assets, teaches you how to find the money to buy the distressed assets. And then at the end of the roadmap is passive income strategies. I think Rob calls it the income flip. And so on our end, there's a lot of different passive income strategies that you could do to get the income flip. The problem with us is we are at the income flip level, but the problem is that I wouldn't say our income is passive because we're actively managing our passive income, if that makes sense. So we're not just strictly passive income. I could do it today if I wanted to. My problem is I don't have anybody to trust to run our portfolio. All right.
Mhm.
Okay, what are we doing today? We're going to talk about investment property needs. And so some of the assumptions that I'm making, this is money for fix and flips. This is money for transactional funding. Now, what that means is there's certain wholesalers that are making such a big wholesale fee, and in order for them to not disclose it to the seller of the house, they just simply do a double close. So they buy it for a period of hours, we fund it, they then sell it to the cash buyer, period of hours or days, and that's what transactional funding means. The money is also being used for buy and holds. You want to build a portfolio, primarily probably on this call, might be residential, but this also works for commercial properties, is for bridge financing, cross collateralization loans, and also for LLC purchases. Now, what an LLC purchase is, it's basically a short sale, right? So if you're buying a short sale from a bank and you've created a single use entity LLC, Well, we will finance the sale of that LLC to another buyer of that single use entity LLC. So these are the assumptions for the investment property needs. Now, the funny thing is Bob Hope once said, a bank is a place that will lend you money if you can prove that you don't need it. How much is that true, right? That's really true. Like, so for tonight, I'm going to a bank event tonight. Freedom Bank of Virginia is opening up a new branch in Tyson's Corner. So I've been invited to that. I've got banks coming at us asking us for lines of credit because they want to lend us money. Well, the problem is we don't really need the money. We don't really need the relationships, but I've got banks banging on our door to lend us money. Okay. So that's kind of a funny slide. Okay. Money sources. I'm going to talk about 5 different tranches of money sources. And you guys, I want to make this as interactive as possible. I'm not really monitoring
The
the
chats.
chat, but if you,
I will help monitor the
okay,
chat. Be at this point, people are just kind of putting in their information. By the way, I would encourage you to, there's 36 people on the call right now. We're probably going to get more people. I would encourage you to put down like where you are, where you invest, type of investing that you do, and then like let's as you have questions, certainly ask the question because that's how people learn. They're
right.
going to learn through your questions. They're going to learn through your engagement, and we'll open the floor up a little bit later, like for people to just jump on. You stop the share. We could just have a discussion. But start putting your questions in and Charlie will do his best to answer them.
No problem. And what you guys can do is I'm going to cover 5 different money sources. And then what I'm going to do is at the end, I'm going to tie it together. Now, some of the subject to information that I'm going to provide you, I'm already starting to tie it together. In other words, I'm going to show you guys how we've utilized hard money lending to go on top of subject to properties. Now, if you don't know what subject to financing is, don't worry about it. We're going to cover it. And if you have questions regarding it, don't worry, ask any questions you want. And then also too, for most of this stuff, I'm going to give you guys live deals. In other words, these are deals that you can go back and look at on the MLS. Everything's in the public record, and you can go ahead and do your due diligence back research if you have to. But I do have a lot of deal examples in here to help you guys learn. All right. Topic 1, hard money lending. What is it? It is basically lending on the hard asset. Hard money lending qualifies the actual asset before and even if it ever qualifies the borrower. In our case, in Clear Sky Financial, we do not really qualify the borrower. I qualify the hard asset. We are a balance sheet lender and I lend on the asset. So basically, what happens is somebody calls me up and they say, hey, I got a fix and flip. It's worth $500,000. It needs $50,000 in renovation. How much of a loan do you need? What'd you buy it for? 300,000. So then what I do, and let's say it's in Northern Virginia. So I'll take that asset. I'll take that after a pair value of 500,000. I'll lend at least 70% ARV, LTV to the ARV, and I'll come up with a number, let's say $350,000. Well, they say I need $300,000. I need a $50,000 renovation budget. Well, because it meets my asset-based parameters, I'm more likely going to lend them a $350,000 loan. So I'm going to give them 100% financing, right? Because
Hmm.
that borrower is buying, they're the ones that found the good distressed asset. So we're going to lend into the ARV of that asset. Now, the next thing I do is I then find out, okay, well, is it a fix and flip loan? Is it a buy and hold loan? What are you going to do with the property? I have to know the exit strategy. So once I know the exit strategy, I then figure out, okay, if it's a buy and hold and you're going to do a debt service coverage ratio loan, which we'll cover here in a second, then I need to know your credit score. But I don't really pull credit. I've never pulled credit. We've probably done almost 1,000 loans and I've never pulled one credit. But if you're going to refinance me out with a DSCR loan because it's a buy and hold, then I do need to know your credit. Okay,
Hmm.
but I'm just going to ask you
Hmm.
questions. I'm not really going to pull your credit report. Now, the next thing we do is I then qualify your contractor because if it's a fix and flip and it needs, let's say, over $100,000 in renovation, then I need to understand who your contractor is. So believe it or not, I'm going to qualify the contractor more so than I'm going to qualify you, the borrower. And I know that sounds really weird to a bunch of people, but that's our business model. Because at the end of the day, I'm already underwriting the deal from a valuation standpoint. I'm underwriting it from a safety standpoint in case we have to take the asset back and execute on it, which is that's not what we want to do. So I need to know that that contractor is competent. So I'm, believe it or not, going to qualify the contractor more so I am the borrower. And I
Hmm.
know it doesn't make sense to a lot of you guys, but that's the way we do it.
Well, that's because that's where a deal can get messed up, right, Charlie?
Yes. And not only for us though, if I have to take it back, our contractors don't want to do another contractor's work. They would
Hmm.
rather start with a blank canvas. And so they would rather start with a property that, right, is fully vacant, not somebody else's work. So that's pretty difficult to come after another contractor. So we need to just make sure that the contractor is competent, they're licensed, okay? Bonded, insured, and all that stuff. Hard money loan types, we have a lot. Fix and flip loans, fix and flip renovate loans. We have buy and hold loans. We have bridge gap funding. I have transactional funding to wholesalers. I've got LLC purchasing for short sale buyers and wholesalers, right? By doing the LLC purchasing model, that allows short sale buyers to actually wholesale their short sale as long as they buy in a single use entity LLC. Because what you got to understand is short sale, the bank is going to approve the buyer. Now, if the buyer is a single use entity LLC, they've already approved that buyer. So then that enables you to sell the LLC and also
Hmm.
multi collateral loans. All right. Okay. Scenarios for hard money. Remember, I'm going to cover the advantages and the disadvantages here in a second. Number one, you need cash, right? Immediate need for financing. Here's the kicker though. Close in a week or less. That's key. I got a deal in on Monday. We're closing it today. Okay. Savage, Maryland. It's a wholesale deal. I guess they couldn't get it closed or finance guy give me a call on Monday. We're closing it today. Now, the caveat behind that is title was pulled. They did have a title binder. A lot of times we have to wait on the title company to do their due diligence and do the title binder to get payoffs and that kind of thing. But there's been many deals we've closed in a week or less. That's pretty much my business. If somebody is closing in 3 weeks from now, I'm like, oh, okay. And I go to sleep for 2 weeks. I don't worry with
Yeah.
it. Why do you need hard money? You got bad credit. You're not bankable. Why do you think you're coming to us? You're coming to us because you're not bankable usually, right? You got bad credit. Your tax returns aren't filed. You're 2 or 3 years late on tax returns. Further leveraging of your business, right? Maybe you bought three fix and flips and you used all cash. You get that fourth really, really good deal, but you need to find money for it. Well, we'll do that too. And more importantly, guys, it's other people's money. You're using us for leverage. Just like the example I told you about the $500,000 ARV, the purchase price at 300,000, the $50,000 reno, I'm going to lend 100% of that deal, especially if it's in Northern Virginia, especially if it's in a subdevelopment that I know is moving. I'm going to lend 70% of that. Matter of fact, I might go to 75% ARV, right? So that's why you're using us. You're using us for little or no money out of your pocket, right? And then I'm going to go over here in a minute to show you how you can use DSCR financing in combination with a hard money loan to go ahead and even get cash out of your investment. Okay. Hard money versus other lending types. Typically, we do not invest in primary residences. That's not really what we do. We're a business to business lender. However, caveat is this: I've done it many times in Virginia. I've done it many times in Maryland. The way we do it in Virginia is we have an attorney originate the loan. He then assigns it to us. Okay, in Maryland, I do own a real estate brokerage in DC, Maryland, and Virginia, but I am not a broker. And so in Maryland, we can lend to a person in Maryland. However, they got to sign something that says they might use us in 2 years on the real estate transaction as a broker. Now, we've never held their feet to the fire on that. They can use whoever they want. But we just have to do certain real estate brokerage disclosure laws in Maryland, and we can originate loans as a broker in Maryland. Okay. It says typically we do not sell loans. That should be really never. We've sold one loan in over 1,000 loans. And so we don't really sell loans. We've sold one. Short-term financing. Most of my loans are 6 to 9 months. I will go a year. Very rarely do I go 18 months. Year is a max, and then I'll give you a year term. You can go 2 years, but there'll be an extension fee at the end of the first year. We have customized lending criteria. It just depends on where you're doing your fix and flip. Northern Virginia, a lot more aggressive. DC right now, I'm very not aggressive, if that's a word. If the word is unaggressive, I'm about as unaggressive as you can be in DC right now. It's very challenging. And so, whereas in Northern Virginia, I might go 75% loan to value of the after repair value. In DC, guys, I might go 60%
Hmm.
because the renovations are so extensive. And if it's a certain subdivision that's not moving, then I'm very, very conservative. We
Hmm.
can close in 24 hours and it's an asset-based loan, no income check, no credit check. Okay. All right. What do borrowers need to know? Remember, this is a lender borrower relationship. But actually, what you're doing is you're renting our money because the money isn't going to be out there very long. So the shorter the money's out there, the more money you're going to make as a borrower, right? So basically, we like to call it, it's more of a teaming relationship because we help all of our borrowers. Anything you want to know, we're going to help you with. Anything along the life cycle of that fix and flip, we're going to help you with it. Do you need a contractor? Okay. Do you need do you need somebody to manage your property? Okay. Do you need tips on selling that property? Maybe you need to get it staged. Maybe you need pricing tips. We're with you the entire life cycle because we service all those loans, right? So when you make the monthly payments, if there's monthly payments built in, then you're gonna make payments on our platform. So you're gonna be with us the entire way. And for us, this is a totally relationship business. So what do borrowers need to know? You need to know your after appraisal value. You better know your project budget, not only from a number standpoint, but from a timeline standpoint. And if you need help with the timeline standpoint, just let me know. Our rule of thumb is if your renovation budget is $50,000, we assume $1,000 a day. We assume that thing is going to take 50 days. Now, for us, when we're fixing and flipping houses, it's more like $2,000 a day. So if it's a $60,000 renovation budget, it's going to be $2,000 a day. We should have that thing done in 30 days. Okay, that's just our rule of thumb. You need to have a good contractor. If you don't have one, we'll help you with that. And you also have to ensure your profit margin. If you're going to come to me with a marginal fix and flip deal that you're getting from a bigger wholesaler that's sort of fudging the ARV and they're fudging the renovation numbers, and if I think it's a tight deal and you're not going to make much money, I'm going to tell you because I don't want to do a deal with you if you're not making the majority of the money because that's what it's all about. You're bringing me the deal. So you need to be able to execute on that deal and you need to be making the money. Okay. We're not here to take money out of your pocket. Now, where you're going to be spending the money with us, obviously, is holding costs. So the quicker you can execute on that fix and flip, the less holding costs you pay, the more profit you make. It's that simple. What a
Charlie,
bar. Yeah.
quick question we had
Uh-huh.
come across. It's you lend in DC, Maryland, Virginia. Where else? Is that just your main market? Anywhere
North
else?
Carolina,
North Carolina,
Louisiana,
Lu-
Florida. Um,
Louisiana, Florida.
Yeah, I will go outside the area. However, I have to know the licensing laws of the state.
Yeah. So
And then
Florida is a yes, Nathan.
say again.
No,
Yeah,
Nathan asked Florida, and I
yeah,
said yes.
Florida's a
It's
yes. Mhm.
yes.
Yeah, because what you have to understand, number one, each jurisdiction has their own licensing requirements, right? We're a lender to lender, I'm sorry, we're a business to business lender. So the private lending laws in Virginia, DC, Maryland, North Carolina, Florida, Louisiana are pretty good. Like, let's say, for example, a state in California, I have to be licensed.
Mm-hmm.
If I'm not licensed, which means an NMLS ID, right? I'm not a licensed loan officer, but I have to be licensed in certain states in order to do private lending. And so we have to know those laws. Number two, I have to have a separate set of loan docs that are specific to that state or jurisdiction. So Maryland, I have a specific set of loan docs. DC, specific set of loan docs. Virginia, same thing. Louisiana, Florida, same thing. And we have to understand the foreclosure laws in all those jurisdictions, right? For example, in DC, you guys are going to laugh. You're going to look at me like I'm an alien. I do not take personal guarantees in Washington, D.C. Do not. And the reason behind that is because I want to do a business to business foreclosure. I want to be able to foreclose on that property right away. And I don't want to have a judge have to sign off on that foreclosure sale. It's a non-judicial process in DC without a personal guarantee. So you have to really know the laws of that jurisdiction on the foreclosure side of where you're lending is very, very
Charlie,
important.
did you learn that the hard way, or was that somebody give you that knowledge?
No, we had a ton of lawyers at the very beginning doing our loan docs.
Mm.
So luckily for us, we needed to know the licensing, we needed to know the foreclosure laws, and we needed to know the personal guarantee laws. So
Mm.
we spent a lot of money on the legal side getting our various loan docs in place.
One of your partners is a lawyer, right?
At that time, he wasn't part of the business. As a matter of fact,
Okay.
he's part of the tax certificate business. He's not really part of our hard money business.
Oh, got it. Got it.
Yeah, he's
Tax
part of the
certificate.
DC tax certificate business. He's the one that got that going.
Cool.
And so yeah, but I do have a lot of lawyers that we know though, and so he is our chief counsel, so he deals with that stuff. Yeah. Okay. All right, what do you got to have? You got to have a lender's title policy, a hazardous liability policy, and you've got to have an LLC in good standing. Okay. I got to go. I probably got to go because we've been doing this for 30 minutes. We're only on hard money lending, man. This might take a minute, but I'll try and speed it up. Underwriting criteria, guys. Number one, 1A, 1B, and 1C. Exit strategy. I have to know my exit strategy. Is it a fix and flip? Is it a buy and hold? Are you going to pay me off? Right? There's a lot of different exit strategies that I have to know. If it's a BRRR, buy, rehab, rent, refinance, repeat, which I'm going to cover this in a second on DSCR loans, I have to know your credit score because I got to know the managing members of the LLC if your credit score is going to allow you to qualify for a DSCR loan, which stands for debt service coverage ratio. I've got to know that. So I have to know my exit strategy. I've got to know the ARV after repair value. Now, I'm going to do my own ARV. I want you to do yours too, because when you bring me the deal, you better bring me the ARV, and then I'm going to compare my notes to your notes. And if we're wrong, we're going to go ahead and say, why is my number lower than yours? Or in some cases, I might say, hey, you know what? You think you can get 550 for this asset? I think you could push 599 because that subdevelopment doesn't have any inventory. So I think you could push a higher ARV on it. So I'll do that. I'll say, hey, look, you're 550. It could be 600. I'll lend at 575 where you want me to lend at 550. So I'll be very aggressive with you. I'll go up to 75% of the ARV. Most of my competitors are at the 65, 70% range on the ARV. Loan to cost is your purchase price plus your renovation. That's what LTC means. And so I'll go 85 to 100% loan to cost. Most of my competitors are at 75 to 80. Loans have nothing to do with the purchase price, guys. It's based on that after repair value. That's where I start. I say, okay, well, how much can you get for the fix and flip? That's where I start. And also, too, the length of the loan. If it's a fix and flip in Northern Virginia, I'm probably going to give you a 6 month loan because you better be in and out of there in 120 days. If it's in Maryland, you might get a 9 month loan. DC, you might get a year loan. It all depends on the size of the renovation and how the market's moving is going to determine the length of the loan. Now, if you want a year loan, no problem. All this stuff is negotiable. You could tell me what you want, and I'll basically most of the times I just give it to you. This is how we build loans, and you'll get this on every type of loan that I do. If you see the numbers 1, 2, 3, 4, let's talk about it. Number one, that's coming from you. You're going to tell me the purchase price. You're going to tell me the renovation budget. You're going to tell me the ARV. Okay. I'm then going to compare. So if you told me the ARV is $575,000, I'm going to say, okay, I'm going to go ahead and run my own comps. This is a this is a live deal. It's 209 Oglethorpe Street. I think we did that about 5 or 6 years ago. And so the buyer came to me with a 625 ARV. The square footage was much smaller. My ARV was 575. So we agree on the ARV. I then go to number two. I then go, okay, what does 70% of the LTV of the ARV look like? Well, if the ARV is 575, in this case, 402, 500. In DC, I was a little bit more aggressive back then, 70% in DC. What's my LTC? Well, in this case, I've never dealt with this borrower before, so I wanted to put at least 5% into the deal. So I went out at a 95% loan to cost. Well, both those numbers were around the $400 range, $400,000 range. And if you know me, I want to make it a simple loan. I don't want to go $399,200 loan. No, I'm going to be simple. Okay, I'm going to give you a proposed loan of $400,000. That's number three. So I fill in the $400,000. It then computes the rest of the number. And then when you go to number four, it's going to give you the amount of cash into the deal, in this case, $40,000. Now, the closing cost number is just an estimated number. In this case, it's 5% of, $400,000. That's going to be your all-in closing costs, including my points fees, title company fees. So all cash in is $400,000. $40,000 is your cash into the deal. Now, look at the deal spread. The deal spread shows a $155,000 deal spread. Now, that is after renovation is done. Okay. So that tells me this is a pretty good deal spread. And so for me, this is a nice conservative loan. And I'm going out at 95% loan to cost. That's pretty good. Now, if the guy came back and told me, let's say he was a repeat borrower, if he came back to me and said, Charlie, instead of doing 95%, I want you to go to 420. If he was a repeater, I probably would have said yes, right? So, it just depends on who you are. So I'll go 100%. and I do it quite a bit. Now, let's talk about the advantages of hard money. And then I'm going to talk about the disadvantages because, in full disclosure, I want you to understand what you're getting yourself into. Yes, we can close within 24 hours, provided title binder is out there. You're using it because of leverage. You're getting approved on the phone with your hard money lender. Like I'm going to tell you, yes, I've never said no to a deal, but I'm very honest with deals. If the deal's too marginal, then you might not want to do it. But you got to tell me you don't want to do it. Think of the loan as renting the money, right? In order to justify the additional cost. That's what you're doing. You're renting the money. Even though it's a borrower-lender relationship, basically my money's on rent for 4 or 6 months. And then there's no prepayment penalty. If you execute quickly, you don't have to pay additional interest. If it's a 9-month loan, you pay it back in 90 days, you only get charged for 90 days. It's that simple, okay? Disadvantages, guys, we all know the disadvantages. Interest rate and points. Those are the disadvantages. Shorter terms, extension fees. So you've got to understand that when you're dealing with hard money lenders, you got to, the first question that you should ask that hard money lender, are you a broker? First question you ask. Question number two, if you're a hard money lender, are you a direct lender? Are you what's called a balance sheet lender? In other words, are you lending your own money or are you going to get money from another hard money lender and get a point? So you have to understand the business model of the hard money lender that you're dealing with. Okay? Any questions on hard money lending? And I'll get into subject two.
No questions at this point, Charlie.
No one's sleeping. All right. Subject two financing. What is it? Okay, here this is very, very powerful, guys, to understand this concept. Subject to financing is basically where a purchaser slash investor takes the title of a property while the seller's existing mortgage stays in place, hence the term subject to the current mortgage. Okay? People keep telling me all the time. I had a partner. I once wrote a article. This was about 10 years ago on Sub 2. And so I had a partner at the time. He was an executive at Fannie Mae. And I wrote an article on subject to financing. I wrote it for Think Realty magazine, and we used to put out a quarterly newsletter to our investors and our funds, right? And I basically talked about sub two financing. He got so mad at me for writing that article because of one thing, because of the due on sale clause of the lender. So remember, he was a retired Fannie Mae executive, right? So he was dealing
Mhm.
with all that stuff. But because of the due on sale clause, he was like, no, no, you're not disclosing to the bank. You're not disclosing to the bank. You're not being upfront with the bank. And so he actually got really, really mad at me. Now, this is a very powerful concept to learn, though, guys. And I'll go through the process here in a second. But what happens is the title slash deed transfers. There's no formal bank approval process. The purchaser slash investor simply takes over the payments. However, the loan stays in the current owner's name. Okay, they're on the hook for the debt obligation, but they are no longer owner of the property. So you guys might be asking yourself, well, why in the heck would an owner do this? Well, an owner would do that because they're in a distressed situation. Maybe the loan's going to foreclosure. Maybe they got to quickly sell their house, right? This is a very powerful tool in today's market where if the market turns on us and you have a seller's market, this is a good tool to sell this house, especially if the seller's selling a mortgage of like 2.75% interest. That's gold.
Yeah, we
Okay.
bought one a few years ago at 2% interest
Yeah.
that way.
But what you have to understand is that most mortgages have a due on sale clause. The lender has the right, this is key. The lender has the right, but not the obligation to call the note. Now, I will go through a couple scenarios where the notes have been called. But what you have to realize is 99% of any sub twos that I've been a part of have never been called. The bank has never called them because the banks don't want to call them. They love the performing assets, even if the interest rate's at 3% or 2% in Rob's case. Okay. The purchaser incurs no liability to repay the loan. However, think about it. If the purchaser is getting a distressed asset at 70% of the after repair value, they're going to pay the loan, right? Because they have a big equity position they got to protect. So basically, there's not much risk on the seller itself, provided there's a lot of equity in that property. So even though the seller still has the loan in their name, the purchaser is going to continue to make that payment because most people buy sub twos to keep in their rental portfolio.
Hmm.
Okay. Limited power of attorney. The seller appoints buyer to the deal with the mortgage company, tenant, HOA, and hazard insurance company. So there is a limited power of attorney as part of some of these deals. Okay. Okay. Why? Right? Why would we do a sub two? Reduces the cost to buy a house. There's no lender fees to originate the loan. There's a lender title insurance policy in place that just protects the title, so you're covered there. You capture a lower interest in a higher interest rate environment. Some people say that we might be in a higher interest rate environment, but I disagree because this is kind of the norm. You know, five and three quarters to six and a quarter, 30-year fixed. I mean, if you look at historical 30-year interest rate, this is the norm. What wasn't the norm was that nice lending period that we went through with low interest rates. That was beautiful. Okay. More room for profit cash flow if kept as a rental. Okay. Further into the amortization schedule, which means more of the payments going to the principal. That's very powerful. And it's just a method to purchase a property if you cannot qualify for a normal mortgage. So if you filed a bankruptcy, let's say 6 months ago, it's discharged, guys. You can buy a sub two mortgage.
Mm-hmm.
Jump into it. You can still buy real estate.
Mm-hmm.
So don't be discouraged, right? Just because you're not bankable, there's a lot of ways to do it. Now let's talk about some deal examples. 163212 Taconic Circle, Dumfries, Virginia. This is a fix and flip that we bought as a sub two, and I'll go into why we flipped it instead of keeping it because we should have kept this thing. But there's other information we'll give you why we didn't do it. The scenario: it was a two-bedroom, one-bath condo, 1992 built, 1,144 square feet. The buyer purchased it March 16, 2008. It was a VA loan, $185,000 at the inception. Okay. Interest rate 3 7/8%, and the PI payment was only 872.48. Annual taxes of 2,800 bucks. So maybe $250 in taxes. You know, there's some condo fees and all that stuff. But it was vacant for at least a year. And it was a referral from a real estate agent. As a matter of fact, it was a referral for somebody in the grid network that referred us this deal.
Mm-hmm.
When we went to buy it, though, the current balance on the VA loan was 168,000, and the purchase contract was accepted at 200,000. So we had to come up with 32,000 in new money to fund this deal. Okay. Purchase price 200,000, subject to loan balance was 168. So cash to seller was $32,000, seller closing fees included. So the renovation costs were $15,000. Our purchase was about a few years ago. The ARV was 285, right? So flip sale 285 with 6,500 seller subsidy. We flipped it for a 278,500 seller net. Flip date. So we flipped this thing in like 90 days and we made three payments and the profit was about $38,000. Now, here's what happened. This is the reason why we didn't keep it as a buy and hold because I would have liked to have kept it. The problem is the seller was a VA seller. So he had his VA entitlement. He didn't feel comfortable with us keeping it as a buy and hold. So that's what we did. We told him we'd fix and flip it. We'll go ahead and sell it. And that's why we didn't keep it as a buy and hold, or we would have kept it as a buy and hold. Okay. All right, next deal. Now, this is a sub two deal that's still in play to this day. The investor still owns it. 799 Ripplebrook Drive, Culpeper, Virginia. Remember, guys, I'm giving you all kinds of sub two examples that you guys can go look up in the public record. The background: single family house, 3 bedroom, 2 bath, built in 1998, cookie cutter subdivision. House was in pre-foreclosure. That's the key. These are all distressed assets. Vacant, out of town owner. The guy lived in New Jersey. How do I know this? Because we drove to New Jersey to give him his money. And we didn't do this deal with the title company. However, I had title pulled on it, so I knew the ramifications. Original loan was $218,000. VHDA. If you guys don't know what VHDA loan is, it's very similar to an FHA loan. However, it's the Virginia First Time Home Buyer Loan Program. Okay, another government sponsored program. Just like VA, Veterans Administration, government loan on the previous example. Loan origination date, 12/30/2015. 3.75% interest rate, 30-year AM schedule. The loan arrearages were $44,002. That's pretty important to remember that. Into the next slide. The current loan amount at the time, 11/8/2021, was 192,500. So they had paid that 218 down to 192,500. And remember, guys, keep this in mind, 30-year AM schedule. So what this deal is, it's a buy and hold sub two with the hard money second trust in place. This particular investor put no money down. And here's what happened. We went to New Jersey. I had a deed done, drafted by a title company, lawyer, send us the deed. We literally met at a Wells Fargo in New Jersey. The owner signed off on a deed for $10,000, cashier check. I knew the substitute trustee for closing on the house. We, well, I did. I brought the loan current for $44,002, sent that money to the law firm to stop the foreclosure, right? So now the person that bought it or the company that bought it, purchase price 192,500 plus in essence a $54,000 second trust by a hard money company. So basically that purchaser put no money down. So the all-in purchase price was 246,502. At the time, the after repair value was 375. Here's the power, guys. The loan payment, once that loan was brought current, the loan PITI was 1365. The rent payment was 1950. You guys follow?
Hmm.
That investor made a positive cash flow for 585 a month, and they had an equity position of about 125. Not bad, right? And they used zero money out of their own pocket. You guys understand that?
Yeah.
Zero money.
Charlie, I didn't know that you guys did this. As we were buying sub twos with my business partner, Mike Capello, I was like, man, there's, 30 grand here, 50 grand there, 70 grand there, like for the like the arrears that you got to come up with plus the reno.
Right,
Like you start running out of money, so you go to some of the private capital that's out there.
right.
I had no idea. I always thought just hard money is going to want that first deed of trust and, and all the rest. And most will because they don't play the game the way you play it from like an operator standpoint.
Right.
Um, but what are the rates on something like that? Curious. Well, if it's a second, sub two, like depends on the person.
12.75 and 3.5, 4 points.
Okay.
I
Yeah, yeah.
mean, maybe in this case, 5 points because what you have to realize, I mean, I'm lending $55,000, right?
Yeah,
People
yeah. You're not
think,
making much on
yeah,
that,
we're
right?
not really making much, but here's the problem. It lies the problem. Remember, I said number one thing I do is what is my exit strategy,
Yeah. How you gonna get
right?
out? So you gotta,
This person is not going to refinance that first trust at
yeah, kill,
3.75. So
kill,
they're going to
kill.
have to pay me back out of their pocket or with another fix and flip profit, right?
Mm.
And that's basically how we got paid back
Or it's kind
because,
of like a bridge gap for the to get the deal done, and then
yeah,
they'll put in like a
eventually,
private lender or somebody else to just pay you
yeah,
off. Is it like a
eventually,
year, 2 years? Like what's the time
yeah,
frame?
yeah, about a year.
Okay.
However, I do know a friend of mine, I can shout his name out, Chris Lay, Fidelity Mortgage. He will give a home equity line of credit on rental properties that are owned
Mm.
by an LLC. So
Okay.
that would be my takeout strategy. But in this case, this person did a couple fix and flips and they just paid us back. So it wasn't a big deal. Okay.
Cool.
So that is a sub two with a hard money loan as a second using no money out of your pocket. Here's another deal, but this is a different kind of deal. So what this is a fix and flip where the fix and flip buyer, matter of fact, they bought three townhouses in the similar Birchdale Square and the B section of Dale City, just like this. They did three sub twos on each individual house, and then we put about a $75,000 second trust on all three houses, and their exit strategy was a fix and flip. So
Mm.
this is one of those three deals. So the background is N unit, two level townhouse, four bedrooms, two baths, two half baths, built 1968, cookie cutter. I love the cookie cutter subdivisions, guys. And I don't care what state it's in. My problem is the rural properties that are on well and septic that I can't
Hmm.
evaluate. Those are
Hmm.
the struggle for us. Also, the 1950s, 1940 assets, something built a long time ago. We struggle with those assets, but I love the cookie cutter subdivisions because I could get a good comp on it. I
Hmm.
could get a good valuation on it. That's what I like the most. In this case, it had needed a renovation budget of 50 grand. Original loan was 133,900. However, the current loan amount at the time was 120. And so it was on a 30-year AM schedule, I think, but it doesn't matter because I'll cover it here in a second. The purchase price was 168. So the sub two loan balance at the time was 120. So they needed to bring 48,299 to close the deal, plus they needed $50,000 in reno. So they needed about $98,000. So what we did is we gave them a second trust at $75,000. We made them bring about $23,000 of their own skin into the game, just because at the time, remember, this is about 6 years ago, and at the time, I wasn't comfortable about putting second trust on top of sub twos. I kind of wanted to see how it worked, so I made the guy bring about $25,000 to the table
Hmm.
or whatever the hell he
Hmm.
brought, and so he flipped out of it 293. We got paid back. The first trust sub two got paid back, and he made, I don't even know what he would made. He made 293. Uh, ARV was 295, but he did sell for 293. So he made, what he made? 168 plus 75. So he made about 70, 80 grand.
Yeah.
Fix and
Made
flip.
good money.
Yeah, and he did it fairly quick. Crepe Myrtle, this is a deal literally that just happened a year ago. Same kind of thing, except this buyer, there was original FHA loan, right? At the time, the current loan amount, 7/31/2025, was 229.31. We put a small second trust on there so they could buy it outright. Another cookie cutter property in Culpeper, 2.875%. Purchased it for 310. Buyer brought the loan current, right, with the second trust. We did a hard money, I'm sorry, we did a hard money second trust on this guy for 90 grand. The ARV was 450, so they had about $140,000 in equity. But what this person did is they just simply bought it, used us second trust hard money, and then they found another sub two buyer who bought it and keeping the sub two in place. So they made a
Mm-hmm.
quick 310, 365. So they made a quick $55,000, and they were 100% financed on that deal.
Hmm.
Okay.
Hmm.
So that's another way to use sub two. In this case, it wasn't, I wouldn't call it a wholesale transaction, but this person only owned this property for maybe 2 weeks.
Yeah.
And then they
Like a
found another
wholesale.
sub two purchaser. And then the person that they wholetailed it to, they have the property to this day and they got it as a rental. And so they've got
Hmm.
about a 1459 positive cash flow on that.
Yeah,
Okay.
what I want people to hear is there these are jujitsu moves, right? There's moves, but if you don't understand the moves, if you don't talk to somebody like Charlie or myself or somebody else that's been in the game, like you don't you see there's opportunity everywhere, but because you don't know it, you don't see it, right? So it's so good that you're doing these examples because then people
Yeah.
they're like, "Oh, that might be possible. I might be able to do this move that I saw Charlie, talk about
Right.
on a webinar."
Right. But I need to let me, all right. I need to talk to something. All right. I'm gonna talk to it at the end.
Okay.
All right. What are the advantages of sub twos, guys? Huh. Interest rates,
Hmm.
right? Terms of the existing note. That's the advantage. No application documentation, no credit check. Don't give me your tax returns, right? Minimal down payment of any if you can work it into the deal. And more importantly, you're further into the AM schedule, which stands for amortization schedule, right? 30 years, 15 years, whatever the AM schedule is, guys. In this particular case, the one property was bought in 2018 at the original. That's already 8 years into the AM schedule. That's not bad. Disadvantages. Okay, this is what I want to talk about. Banks can recall the loan on an ownership change. I'm going to repeat it. Banks can recall the loan. The former owner is still on hook for the obligation. That's not a disadvantage to you being the buyer. That's a disadvantage to the owner, the old owner. However, what I got to explain to you guys is something very, very important. Out of 100 of these deals, there's only been two sub twos that I know that have been called, and they were both owned by a bank by the name of Sandy Spring Bank. Okay, let me explain to you what happened with Sandy Spring Bank. Sandy Spring Bank had a lot of bad commercial loans and they had to raise capital. So, as a bank, there's only a few ways to raise capital, guys. Number one, increase deposits. Number two, sell off performing assets. Number three, sell off non performing assets. Or number four, let me see if any of our loans that we put out there in the past have changed ownerships and we can call the sub two.
Mm-hmm. Hmm.
Okay.
Hmm.
So in this case, they called two of their loans. Sandy Spring called two of their loans, and that's the only time and instance that I have heard a bank call a loan. Now, most of the loans are with your institutional parties, and when I say institutional, I mean the government, I mean FHA, I mean VA, I mean VHDA, I mean USDA, and also too institutional lenders like Bank of America, Wells Fargo, Capital One, all the bigger players. All the bigger players understand that they don't want to call that loan on an ownership play because they would rather keep those loans in their portfolio performing than the risk of originating another loan that could go to foreclosure. So you have to understand that. And
Mm.
also, too, by the way, some of these loans have been securitized. In other words, they've been sold up to Wall Street and they're in some security tranche. And so to pull that loan out of a security tranche is a pain in the ass. So that's another reason why your institutional players don't do this. They don't call these loans. Okay? That's important for you to know. How to find subject to deals. Pre-foreclosure ads, right? Sometimes we'll have the interest rate of the foreclosing instrument, out-of-town owners, realtor referrals, driving for dollars, subject to mailers. This is my favorite thing. Subject to mailers. Focus on lists where mortgage originations happen between March 2019 and March 2022. Right? That's where the majority of these, Rob, I'd be interested on the one that you bought with a 2% loan. When was that thing originated? Do you
It
remember?
was modified.
Oh, it's modified.
It was a modified. We bought a couple that were like that where like I think we're 10 years into the AM schedule right now.
Okay, perfect. Yeah,
Yeah.
yeah. So that was a 216 origination. Yeah.
Yeah.
So that's great. That's even
And then
better.
it got modified
Yeah.
and we have one that we own on Blue Mountain Road that has two loans, but one and it got modified. But the second note is for zero, like
Yeah.
0% interest. Did you
That's
ever see that?
FHA. Yeah, that's
Yeah.
FHA. Yeah. So what happens is, guys, and this is Rob, thank you very much for doing this.
Hmm.
On FHA loans and a lot of times VA loans, these government institutions do not want to foreclose on people. They do not. The only time if you see a FHA VA foreclosure is if the person has gone dark on them and they don't call them back. They don't communicate. They will do anything to modify the loan. They'll go to 40-year AM schedules. They'll put the principal as a second trust, like Rob said, like a $12,000 rearage second trust as a second trust, but it's a 0% second trust.
Hmm.
They'll reduce the interest rate. Let's say it's a 4.5, 5% interest rate. They'll reduce that thing to 3.5%. They will go for miles to not allow you to foreclose. And then, oh,
Yeah.
by the way, these now become sub two instruments, the loan
Yeah.
mod. The only thing with Rob is, Rob, I'm sure you still have those small second trusts on title, right?
Yes.
Yeah. Okay. No big
Yes.
deal. 0%. Who cares?
Yep.
Who cares? Okay. All right. Debt service coverage ratio loans. Topic three. Any questions out there in the community before we move on?
Let me see if I see any. I think we're good.
All right.
Keep rolling.
All right. Debt
We
service
could always
coverage
open it
ratio.
up at the end, Charlie.
No problem. All right. Here's what it is. A DSCR loan is a loan for buy and hold investors. Okay. What it does is the income of the property is the key qualifier. It's not the only qualifier, but it is the key qualifier. They're not going to qualify your personal income. They're not going to ask you for tax returns. However, they're going to take your credit score into consideration. So you need to have a 660 or above credit score. Matter of fact, this is an LLC only loan though. LLC to LLC, right? They're not going to lend to your person. So you got to have an LLC. Now, on a 660 credit score, they look at the 25% ownership or more within the LLC. So if you have four owners, 25, 25, 25, 25, they're going to want the credit score of all four owners. If you're a
Mm,
sole member, they only care about your credit score. If you're 50-50 like I am with Sam, then they're going to want to see both your credit scores. So both credit scores got to be 660 or higher. Now, that fluctuates. I've seen DSCR lenders go to 580, 560, but your interest rate's going to be through the roof. It might not make sense. So, make sure you have 660 or above. Okay. It could be done on a single property or a portfolio of properties. I've got a 40 property DSCR loan with Sandy Spring Bank, who now are Atlantic Union. Now, I was very upset when Atlantic Union decided to buy Sandy Spring because I was trying to buy our 40 unit portfolio loan from Sandy Spring at a discount. And so when Atlantic Union came and bought them, that kind of ixnayed that idea, dummy. So, so it never happened. The other thing you could do is you could pick your AM schedule, 30, 25, 20, 15 year, et cetera. Obviously standard, it's 30-year AM schedule, right? But you can pick your AM schedule. They're going to require 3 to 6 months interest reserve in cash. You can have multiple loans. And in this case, if you're buying it straight with a DSCR loan, they might require you to have a 20 to 25% down payment. Here's the strategy. The strategy is to buy a distressed asset, use a hard money lender to fund 100% of that loan, get a tenant in there, and then refinance that hard money lender out in 6 months and a day with a new stepped up appraisal. And then odds are you're probably going to have to come up with none of your own money out of your pocket. And you have a performing asset and you've got a much lower interest rate.
Hmm.
Okay. That's the strategy with DSCR loans and using hard money lender. Here's the DSCR calculation. Guys, all it is a ratio. And so the top part of my ratio are property rents, right? It's the income ability of the property. Now, if you're dealing with pad split or those kinds of things where you're house hacking, then or Airbnb, right? Then it's a little bit different qualification process. They're going to want to see a little bit more 6 months worth of income ability of that property. Now, if it's just a straight lease, 30-year, 1 year lease, right? And you got a single tenant, it's the property rents divided by the PITI. A stands for association dues, could be condos or HOA. That gives the DSCR ratio. An ideal DSCR ratio is about a 1.1, 1.2. Okay. So in my example, where the rents were $2,500, the monthly payment's $2,000, you simply get a 1.25 DSCR, debt service coverage ratio. Okay. The higher the DSCR interest rate, I'm sorry, the higher the DSCR ratio, the lower the interest rate. The higher your credit score, the lower the interest rate. No personal income requirement. Okay. So keep that in mind when you're trying to go get a DSCR loan. Advantages: flexibility. You could have multiple loans over multiple properties. No 10 loan limit like on conventional loans. Flexible AM schedule and interest rates. Now, disadvantages: interest rates, right? As the interest rates were going up, guys, with prime, right? And as the feds were raising interest rates, these interest rates are going to rise accordingly. Okay. Disadvantages: interest rates and credit score requirement. Now, the biggest buyer of DSCR loans is insurance companies. It's your State Farms, it's your Nationwides, it's your MetLife. Those are the ones where these integrators are portfolioing these DSCR loans and they're selling it to the insurance companies. That's who the primary funder of DSCR loans are. So
Hmm.
aggregators are aggregating them and then they're selling them to insurance companies. Okay.
Charlie, why didn't you ever sell your paper?
For us,
Yeah, because
because we're greedy and we wanted to keep all the yield.
yeah, yeah, why not? Why
I
not?
mean,
But
that
you
at the
know,
end of the day is why we keep it all
I
because
think I think, the argument on the other side was, a friend of mine that sells the paper.
you know,
It's just like they didn't want the risk on their balance sheet, right? That
yeah.
was
Yeah, but I'm mitigating the risk,
yeah, I
right?
hear I
So
hear it, right? Like
yeah,
you're mitigating the risk, you're making good loans, you're making
yeah,
sure it's, they're all good. Yeah.
yeah. Now, are they all good? No. Do I have to foreclose? Yes. Do I want to? No. But because we're in a smaller, compacted area, remember, we're only in 6, 7 states, and I'm not very heavy in those other states. I'm heavy in the DMV. I could go drive to that asset with an hour, hour and a half non-traffic. I could take it back and I could execute on it and then get
Hmm.
my money back. I don't want to do it, but we can. And
Hmm.
so that's why we're able to be a little bit more aggressive. The other problem is the reason why I didn't sell any loans off is because I didn't want anybody else to know who my end user buyer was. I'm very territorial on my hard money clients because
Hmm.
I have a lot of hard money clients that have done 20, 30, 40 loans with us. I
Hmm.
don't want anybody to know who they are.
Hmm.
Now,
Hmm.
eventually, though, these guys will do all those deals and they'll graduate from me. I mean, it's
Hmm.
sort of like I'm, releasing a bird from the nest, right? They're going to go to maybe Fund That Flip or Kiavi or, one of my nationwide competitors who can give them cheaper interest rates and they're going to fly the nest. Do I hate them? No.
You do
Congratulations.
too. So are they supposed to be training you and you're supposed to be helping? Not training, just me helping. So it's you just straight helping. Yep.
Oh,
You need to
sounds like
shave.
we got to mute somebody.
Do I? Yeah.
Oh, well, I thought they were asking me if I was training
Yeah, me
somebody.
too.
God, I
Me
need to
too.
train somebody to take
Yeah,
over my
I
Okay,
like
business.
the
we're
instructor here
coming
for you
up.
or do you
We're
instructor
coming
first?
up. We got
Yeah,
to
we'll
mute
see.
somebody. Ria,
Yeah.
maybe you can mute him if you see him.
Me?
I like the picks again. It'll just come down to so it was said.
All
There
right. I
we
think that
go.
was me.
They
I'm
got,
sorry. You gave me
that's okay.
control. I got it. All right.
Charlie, let's we're at top of the hour, right?
Shocker.
I think owner financing an important one. How many topics do we have? We've got five, you said?
5. Yeah, I could go
Okay.
to the end if you want. I could go to the end. All right, owner financing. That's another way
Charlie?
of financing these things. Okay. The next thing you guys got to understand is assuming FHA, VA loans, right? That's another way to buy these properties. Now, the assumption process takes about 45 days. You've got two levels of assumption on FHA and VA. FHA's got to approve it, and the service loan company, the mortgage company's got to approve it. Same
It
thing with
takes a
VA.
long time. It's a pain in the butt.
45 days. Another way to do it. Same thing, traditional loan strategies, guys. But let's just go to the end. What did we cover? We covered hard money lending sources. We covered subject to sources, DSCR sources, owner held financing, even though we didn't cover it very much, and then VA FHA loan assumptions. So by combining these different funding mechanisms, you can purchase properties with little or no money out of your pocket. And I covered a bunch of deals where that was the case. Questions? You guys
Yeah,
have any
let's open it up.
questions?
Let's open it up some questions. Like, go ahead. You could take the Charlie, stop the share,
Okay.
and then we'll let people.
All right. Stop the share. All right.
There you go.
Stopped.
I
Let's.
just want to say, Charlie's the bomb. Really, he has golden nuggets of information. I go to every one of his meetups. He was nice enough to refer one of his loans to me. He just closed one of my loans. So, it's a small community
It is. It's
business
awesome.
for everyone.
See, the thing is, Rob, when people do that, I have to write them a check. No more comments. Thank you, Mark. Mark Barron's great guy. Yeah.
Charlie's the bomb. Send me the check. There you go.
Yeah.
Who's got any questions? Maybe it's a strategy question. I saw some Nathan asking some additional questions.
Yeah, that question was so is it possible to pull a DSCR loan not using an LLC?
Mark, that
Or
might
is
be a
it just
question.
uncommon?
It's very, very uncommon. Yeah. If you're buying properties, I would get an LLC going, limited liability corporation. And the reason why you're doing that is you don't want to commingle your investment assets with your personal name, just in case something happens within that LLC, right? You don't want it to come back to you personally. And I always look at things from liability standpoint. What's my maximum exposure? And so in our case, my holding company is Clear Sky Properties. That's where all of our fix and flips are and all of our rentals are. So I keep everything in one LLC. But what I do is I have an umbrella general liability policy. So if somebody goes and sues those companies, which I'll tell you right now, it's a shocker if I told you we weren't getting sued. I mean, we're in court now on an AI case where somebody's using artificial intelligence to sue us as the lender. And so I don't want any personal exposure to any of that stuff. So if I were you, I would go ahead and create the LLCs and keep your investment properties within that LLC. Yeah.
Yeah, that particular question is about I have kind of two different scenarios of why I'm coming kind of at this meeting, and that one is about my girl and I are in the process of trying to buy a house, and her lender suggested that we do it as a DSCR, and she's, it's not using an LLC. So this happened to come up during this call, and it raised some questions for me.
Mark, you know any DSCR lenders that will go person to person? I don't. I think we put them to sleep.
Yeah.
I'll find out. Rob, I need your contact information. I'll go
Nathan,
find it.
maybe you could put your contact info
Yeah,
in.
I've never heard of that. I've never heard of DSCR lender going straight to a person. And I'll
Yeah.
tell you why. The problem is the disclosure laws of a consumer versus an LLC, right? Because when you're an LLC, you don't go under the consumer disclosure laws, right? So you like when you're going bank to person, you've got to go through TRID, you've got to go through all the disclosure stuff. One of the things that we do as a business to business lender is we avoid all that stuff.
Yeah.
And so that's why
Wild
DSCR,
West, business to business.
yeah, and the other thing too is when these DSCR lenders, when they lend the money, they're packaging up these loans and aggregating them and selling them in bulk to the insurance companies. If the insurance companies see an individual on that, they might not they might reject that loan.
Would
So
it be a downside if it was a like brand new fresh LLC?
no downside. Perfect. Single use NCLC. That's perfect. Yeah.
Yeah.
Okay.
Yeah, because
Well,
it
if that
takes
Simple,
comes
a,
up,
simple
then
to
that's
set up.
definitely an easy
it,
solution.
yeah, it's
Something.
simple to set up, but it takes you, and more importantly, it takes the lender out of the consumer laws. See, as a consumer, you have a lot of rights. And us lenders, we want to know that we're lending to business people, somebody that has knowledge, right? I don't want to lend to some consumer who might not have this knowledge. And so that's a risk to us. All right, good question. That was good. Hopefully I helped.
Yeah, great question. Charlie, as always, it's a pleasure to have you on here. We're gonna have you at GridCon June 1st. We've
Thank you.
got, man, we've got a lot of people from all over the country flying in
Thank
two
you. Yeah.
days. If you haven't gotten your pass, your GridCon pass, do it. Like day 2 is completely booked. Day 1 still have some spots available, right? Um, Charlie, any final thoughts before you leave us?
Yeah, I guess I do have a lot, but I won't share them. No, my number one, my number one thought is Rob. Thank you very much. And I have to be honest with this, and I have so much respect for Rob and Grid and what you guys are building across the country. And you guys on this call, you got to keep going to these meetups and keep learning as much as you can learn. This is not an easy business. You can lose money in this business. And Rob is trying to share connections, he's trying to share knowledge. And so being part of this Grid network is very, very powerful. When I first got started on the hard money side, I was actually doing presentations to Kaza when Kaza was the investment in the DMV. And so I got to thank those guys because I go back a long way with the Kaza group, with Grid, and I was giving presentations before I actually knew Rob personally. So I'm very happy with him and what he's doing with his organization. As we can give back, we're going to give back. And
Yeah.
and thank Rob for having me at GridCon and you guys sign up and please, I want to see you on June the 1st.
Charlie, if somebody wants to get your book, Road to Wealth, do they go to a special website for that?
Yeah, it's called Amazon.
Amazon.
Yeah.
Grid
Yeah,
to
we're on
Wealth.
we're everywhere. We have an audio book. We have the hard copy, soft copy. It's I'll have some at GridCon. If you guys show up for GridCon,
Cool.
yeah, I'll have some to give you guys. You're more welcome to purchase. But let me tell you something, guys. You don't make money writing books.
Yeah, yeah, yeah. It's
It's like,
yeah, 100%. You write it because it's in you to give,
yeah,
right?
yeah.
And you want to give it out. And one of the things that we didn't talk about, you could listen to it in the podcast that I dropped today on the Income Flip podcast. Charlie started on the agent side of the business
Oh yeah.
and
I forgot
then
to cover that.
over time, right, migrated into the uh hard money space. And it's kind of cool because he's got all these channels that feed his holding company. But knowing his heart, it's the charities that are at the kind of the center of it,
It's the
which is a
charities.
cool space to be in, right? Like that's a very cool space, Charlie. Like I admire you for doing that. Very
Thank you for
cool.
saying that. Yeah,
So
it's the charities. That's why people always ask me, when are you going to retire? When are you going to retire? I'm like, what the hell am I going to retire for? I
yeah,
don't know
you
what
like what you're doing.
I
You
don't know
like
what
what you're
I'm
doing.
do. I love what I'm doing and I got to drive the charities because when I'm gone, man, that thing's still going to be around. Someone's got to run it.
Okay,
Thank you,
guys.
Rob. Thank
Hey,
you.
Yeah,
Charlie and Rob, can you guys drop your contact info in the
Yeah,
chat box or
mine's
something?
in there. 703-887-1039 and my email's in there too.
sure. I'll put mine in. Mine's just Rob Chavez 703
Rob, I thought everybody knew you.
I
zero
think I
nine.
maybe I
This
think
is
I maybe
funny.
missed yours, Charlie, because I was a little late to the call. So the
No, no,
full
no.
chat,
Mine's
I
in
don't
the
think.
chat. Look at the chat. Look in the chat. It's there.
Yeah, I don't think it shows recent.
Yeah, Charlie at
Oh, it's that one. Gotcha.
skyfinancial.com.
Yeah, and then it's
Gotcha.
703-887-1039. Call anytime, guys. Like I said, I hope to see you guys on June the 1st. That'd be good to see you in person.
Yeah,
Yeah.
awesome. Okay,
Thank you
everybody,
much,
make
guys.
it a great day. Take
Thank you,
care.
guys. Thanks, Rob.
Bye-bye.